Hey everyone, welcome back to Conviction Bet. Hope you're doing well. Nvidia has reported and the numbers are extraordinary. We have had a remarkable few weeks in markets. A 6-week winning streak on the S&P, a new Fed chairman, and a Q1 earnings season where several of the biggest names in tech reported record or near record quarterly profits. There is a lot to work through, and I want to take you through all of it properly. And speaking of things that should not logically be happening at the same time, the S&P 500 hit an all-time high on May 8th. Oil was at $104 a barrel. The Federal Reserve just voted 8-4 in the most divided meeting since 1992. Consumer confidence sat near its 2022 trough. And the producer price index was running 6% above where it was a year ago. The market looked at all of that and decided to go up for the 6th week in a row. But here's what actually matters this week. Several mega cap tech companies just reported record or near record quarterly profits. The major AI infrastructure spenders, Alphabet, Amazon, Microsoft, and Meta, are pointing toward about $650 billion of combined 2026 capital expenditure, larger than the GDP of most European countries. And Nvidia has now reported extending the streak with 85% year-over-year revenue growth. The market is telling a story about the AI boom. The real story is about what is actually inside these numbers and why the most important line in big tech earnings for Alphabet and Amazon was not revenue growth, not cloud acceleration, not operating margin. It was a footnote about a private startup. I'm J.L. Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. I'm going to explain the feedback loop that is actually driving this rally and show you why it is more circular than it looks. I'm going to walk through what NVIDIA's numbers actually tell us about the state of real demand versus reported profits. And I'm going to explain the single most consequential monetary policy question of the year, not whether the Fed cuts rates, but whether the new chairman is quietly redefining what inflation even means. That last one is the one most people are not paying close enough attention to. Let me start with the rally itself, because the context matters. The S&P 500 closed at 7,398 on May 8th, a fresh all-time high, capping 6 consecutive weeks of gains, the longest winning streak since 2024. By May 20th, it had extended to 7,432. Both indices have recovered more than 13% from their late March lows, when equity markets were pricing in full-blown stagflation. Now, what was happening simultaneously during these 6 weeks? Brent crude touched $104 a barrel. The Strait of Hormuz disruption has dragged on for more than 2 months, roughly 69 days by recent reporting, with U.S.-Iran tensions keeping energy markets on edge and drawing down global oil and gas inventories toward critically low levels. The FOMC voted 8-4 at its April 29th meeting, the most divided Federal Reserve decision since October of 1992, to hold rates steady at 3.5 to 3.75%. The producer price index for final demand rose 1.4% in April alone and 6% over the prior 12 months, with services driving the monthly increase and energy driving the goods components. University of Michigan consumer sentiment hit a preliminary reading of 48.2 in May, near the trough reached in 2022. In any standard macro analysis, that combination war, high energy, a divided Fed, 6% wholesale inflation, deteriorating consumer confidence would be described as stagflationary pressure. The textbook response is risk off. The market responded with a 6-week winning streak that culminated in fresh all-time highs. There is a convenient explanation and a real one. The convenient explanation: big tech earnings were so strong they overrode everything else. And that is partially true. The S&P 500's earnings per share grew approximately 15% year over year in the first quarter, with the information technology sector contributing nearly 80% of the earnings increment. One analyst put it plainly: the S&P 500 has become an AI index. Magnificent Seven plus 493 other companies along for the ride. But the convenient explanation does not fully hold up when you zoom out. The Buffett indicator, total U.S. market capitalization divided by gross domestic product, sits somewhere between the low 200s and roughly 230%, depending on which methodology and which denominator you use. Advisor Perspectives puts it at 229.5%, the second highest reading in its data series. Guru Focus places it around 234.5 using total market cap to GNP. Buffett himself once said that if this ratio approaches 200%, you're playing with fire. We are measurably through that threshold. The dot-com crash of 2000 happened after the indicator peaked at 146%. The 2008 financial crisis followed a peak of 109. Even the lower end of the current range is far above the level reached before the 2008 crisis, and the market is still going up. So the real answer is this. The market is behaving as if it has decided to prioritize one specific feedback loop, the AI positive cycle, over every macroeconomic headwind. Understanding that loop, its genuine strength, its mechanics, and its fragility is what this episode is about. What this tells you as an investor: when a market stops reacting to bad news, genuinely stops, as if the data does not exist, that is not a sign of strength. That is tunnel vision. Tunnel vision ends one of two ways. The tunnel opens into daylight, or it runs into a wall. We do not know which. What we can do is understand exactly what we are looking at. Now, the footnote economy. There is an ancient symbol, the Ouroboros, a snake biting its own tail. Eternal, self-sustaining, feeding on itself. That is what big tech earnings look like in the first quarter of 2026. Let me show you how the loop works. Alphabet reported net income of $62.6 billion in Q1, up 81% year over year. The number crushed every estimate. Analysts declared victory. The stock rose. Now read the footnote. Buried in the earnings release in the other income and expenses line was $37.7 billion, described as, quote, primarily the result of net unrealized gains on our non-marketable equity securities. Using Alphabet's effective tax rate, the estimated after-tax contribution to net income from those gains was roughly $28.7 billion. That is approximately 46% of the $62.6 billion headline number. The gains were driven per widely reported analysis by markups in Alphabet's private AI holdings, with Anthropic widely cited as a major contributor. Anthropic recently disclosed annualized revenues surpassing $30 billion and was in discussions for a funding round that would value the company somewhere between $850 billion and $900 billion. As that valuation rose, it flowed through Alphabet's income statement as reported profit. Here is the loop. Alphabet invests in Anthropic. Anthropic trains its models on Google Cloud. Google Cloud revenue grows, which contributes to Anthropic's commercial success, which supports Anthropic's valuation. Anthropic's valuation rises, flowing through Alphabet's other income as reported profits. That profit reinforces investor confidence in Alphabet. Investor confidence enables Alphabet to invest more in cloud and in Anthropic. Around it goes. Amazon's story is structurally identical. Net income surged to $30.3 billion in Q1, up 77% year over year. Amazon disclosed $16.8 billion in pre-tax gains from its Anthropic investments, triggered by the same funding round valuation markup. Strip that out, and the underlying operating quarter is real but meaningfully more modest. Meanwhile, Amazon's trailing 12-month free cash flow collapsed from $25.9 billion to just $1.2 billion, a 95% decline, as CEO Andy Jassy commits roughly $200 billion toward AI capital expenditure in 2026. I want to be precise about something, because this point matters. This is not fraud. Every number is correctly reported under current GAAP accounting rules, specifically under ASU 2016-01, which requires unrealized gains on equity securities to flow directly through the income statement. The accounting is correct. But carefully, you need to understand what you are actually looking at when you read a headline net income figure. This is the Ouroboros mechanism. AI investment creates private market valuations. Those valuations create reported accounting profits. Those profits reinforce management's confidence in investors' willingness to keep funding the build-out even as the actual cash burden shows up in free cash flow, finance leases, and debt markets. The loop is self-reinforcing until it isn't. What this means for you as an investor: if you own Alphabet or Amazon because Q1 earnings look strong, understand the composition. Strip out an estimated $28.7 billion in after-tax unrealized private equity gains, and Alphabet's estimated operating earnings per share was still a beat, roughly $2.76 against a $2.63 consensus. The underlying business is genuinely good. Google Cloud grew 63% to $20 billion in quarterly revenue, and its contracted backlog nearly doubled quarter over quarter to over $460 billion, more than half expected to convert within 24 months. AWS grew 28%, the fastest pace in 15 quarters. The real revenue is there. But nearly half of what moved Alphabet's headline number was a reflection, an accounting echo of a valuation loop that runs through the same ecosystem the company is already inside. Know which part you're paying for. But that's only half the story. There is one company in this ecosystem where the cash flow and the reported profit are telling the same story. And they have now reported NVIDIA, Q1 of fiscal 2027. Total revenue, $81.6 billion, up 85% year over year. The consensus was $78.8 billion. Beat. Data center revenue, $75.2 billion, up 92% year over year. 92% of total company revenue just from data centers. Free cash flow, $48.6 billion for the quarter. That free cash flow number, $48.6 billion of company-level free cash flow generated by a business now overwhelmingly driven by data center hardware. Not paper gains. Not equity markups. I should be transparent about one wrinkle. Even NVIDIA's GAAP net income contains a mark-to-market element. GAAP net income came in at $58.3 billion, up 211% year over year, but that figure includes $15.9 billion of equity securities gains. Strip those and other adjustments out, and non-GAAP net income was $45.5 billion, up 139%. The irony: even the cleanest cash machine in AI now has a footnote. Dryly, welcome to Q1 2026. But here is why NVIDIA is categorically different from Alphabet and Amazon on this point. The core investment thesis, the reason anyone should own NVIDIA, does not depend on the equity securities line. The $48.6 billion of company-level free cash flow tells you everything you need to know about whether the demand is real. It is real. Second quarter guidance came in at $91 billion, roughly $3.5 to $4 billion above consensus. Here is the detail that matters most. That guidance assumes zero data center compute revenue from China. Zero. That guidance assumes no China data center compute revenue. Specifically, U.S. export controls have restricted that category. And the guidance is still $91 billion. Let me sit with that number for a moment. $91 billion of company-level quarterly revenue guidance, with China data center compute excluded from the calculation. U.S. export controls have effectively handed NVIDIA a natural experiment. How much AI infrastructure demand exists in the rest of the world without Chinese data center compute? The answer in NVIDIA's fiscal second quarter guidance is $91 billion of total company revenue annualized. That is more than $360 billion per year from a single company in markets that exclude the world's second largest economy's data center compute spending. Jensen Huang's words on the earnings call, demand has gone parabolic. Agentic AI has arrived. Blackwell GPU supply is fully booked into next year. Semiconductor customers are pre-booking capacity through 2028 and 2030. The roughly $650 billion in AI capital expenditure being committed by the major hyperscalers this year has to go somewhere, and a meaningful share is flowing through NVIDIA and the broader semiconductor supply chain. What this means for you as an investor. NVIDIA is the one place in the AI value chain where you can look at the free cash flow line and know you are not counting reflections. The question of whether that justifies the current valuation after a 65% move in the semiconductor index in 2026 at roughly 26 to 27 times forward earnings on 2027 estimates is a separate and legitimate question. If the 50 to 100% earnings growth that analysts are projecting holds for 2 to 3 years, the valuation is defensible. If it holds for 1 year, you are paying a growth multiple for a cyclical company. Know the difference. But the fundamental demand signal, the $48.6 billion in company-level quarterly free cash flow, is as real as anything in this earnings season. Now, let's talk about the hinge. Everything I've described, the AI positive feedback loop, the circular valuation dynamics, NVIDIA's extraordinary demand signal runs on one input: the monetary financial environment. And that environment just changed hands. Kevin Warsh was confirmed as Federal Reserve Chair by a 54 to 45 Senate vote on May 13th, the most divisive Fed confirmation in American history. Warsh was set to take over as Powell's chair term expired on May 15th, but Powell did not leave the building. He retained his seat as a Federal Reserve Governor, a position that runs until January 31st, 2028. That means Powell keeps his monetary policy vote sitting at the same table as his successor and providing an institutional counterweight against any abrupt directional shift. It is a structurally unusual arrangement, deliberately chosen. The most consequential aspect of the Warsh transition is not his posture on rate levels. It is his proposed reformation of how the Federal Reserve measures inflation. Powell's framework measured progress toward the 2% inflation target using Core PCE, which as of March 2026 reads 3.2%. That is 120 basis points above target. Under that framework, rate cuts look distant. Warsh has explicitly endorsed a different measure, the Dallas Federal Reserve's trimmed mean PCE. The Dallas measure strips out the top 31% and bottom 24% of the monthly price change distribution, averaging only the middle 45% of the consumer basket. As of March 2026, the trimmed mean reads 2.4%. By that gauge, the Fed is 40 basis points from its target, not 120. Now I want to address something directly, because it trips up a lot of commentary on this topic. When you see Core PCE at 3.2 and trimmed mean at 2.4, the instinct is to say energy prices are driving the gap. That is wrong. Core PCE already excludes food and energy by definition. Oil shocks cannot explain a gap between core and trimmed mean. The actual explanation is shelter and services. Rent and equivalent housing costs have been among the largest single contributors to Core PCE's persistent elevation. These are large in magnitude, slow to unwind, and critically, they are lagging indicators. They reflect lease agreements signed 12 to 18 months ago, not what is happening in the rental market today. The trimmed mean strips them out not because they are volatile in the traditional sense, but because they are statistically extreme relative to the rest of the basket in any given month. Warsh's argument is that these shelter readings represent an echo of post-pandemic price level adjustment, not an ongoing inflation signal. If he is right, the path to rate cuts is much shorter than Core PCE implies. If he is wrong, and shelter costs reflect genuine ongoing demand pressure, then cutting toward a 2.4% reading would be a meaningful policy error. There is a legitimate academic case on both sides. The Brookings Institution has documented the debate, and here is the irony Warsh may be walking into. The Dallas Fed, the institution that built this gauge, cautioned that the trimmed mean underperforms precisely when price increases are broad-based across many categories, not isolated to a few. Broad-based inflation driven by energy, tariffs, and lagging shelter simultaneously is exactly what we have right now. The risk is that a trimmed mean framework may be less informative precisely when inflation is broad-based across many categories rather than driven by a few outliers, which is the environment Warsh is inheriting. One more structural fragility to name before we get to the conclusion. The global private credit market has grown to $3.5 trillion in assets under management. A meaningful portion of that, concentrated in 2020 to 2022 vintage borrowers, is financed with floating rate debt underwritten when rates were near zero. Several leverage buyouts from that era have interest expense that now exceeds EBITDA. They have not technically defaulted private credit restructures rather than marks to market. But restructuring is not repayment. Regulators on both sides, the SEC on private fund transparency, the Federal Reserve on bank exposure to private credit, have signaled increasing scrutiny of this market. CoreWeave gave us a preview of what fragility looks like in this chain. May 7th, CoreWeave reported $2.08 billion in Q1 revenue, up 112% year over year. The stock fell after hours. Not because the growth was bad, 112% is not bad, but because Q2 guidance came in soft and the company's CapEx intensity tens of billions against $2 billion in quarterly revenue unnerved investors. The market is not just asking whether the demand is real, it is asking whether the financing structure can hold. CoreWeave triple-digit growth, falling stock price is the answer to that question in real time. The hyperscalers, Alphabet, Microsoft, Amazon, Meta, are not funding their AI CapEx through these same floating rate private credit structures. They use investment-grade bond markets, cash reserves, finance leases, and investor tolerance for compressed near-term free cash flow. These are two different risk pools, but they share one pressure point: the cost of money. And both are sensitive to what happens in the next Federal Reserve press conference. What this means for you as an investor. Warsh's first FOMC meeting is June 16th and 17th. Whatever he signals in that press conference, particularly on which inflation gauge he intends to weight most heavily in policy, communications will tell you more about the next 12 months in markets than any single earnings print has. If he signals a move toward trimmed mean, the path for rate normalization looks different. If he maintains core PCE discipline, the AI CapEx cycle faces a tighter financing environment sooner than the market currently expects. This is the hinge. Watch it. Let's bring this back to what it means for an investor. The bull case is real. Google Cloud grew 63% to $20 billion in quarterly revenue. Its contracted backlog nearly doubled quarter over quarter to $460 billion, with more than half expected to convert within 24 months. AWS grew 28%, the fastest pace in 15 quarters, to $37.6 billion. NVIDIA is guiding to $91 billion in total company revenue for its next quarter, with China data center compute excluded from the calculation. Semiconductor orders have visibility into 2027 and beyond. Company-level free cash flow of $48.6 billion in a single quarter. The infrastructure being built is real. The demand for it is verifiable. And I know what the bear case is. The Buffett indicator, depending on methodology, sits somewhere between 215 and 235%. Even the lower end of that range is nearly twice the level that preceded the 2008 financial crisis. Amazon's trailing free cash flow has collapsed 95% in a single year. A growing share of this CapEx is being financed through bond markets, finance leases, and investor tolerance for compressed near-term free cash flow, especially in Amazon's case, where trailing 12-month FCF has fallen to just $1.2 billion. That patience has a price, and that price is set at the Federal Reserve. The $3.5 trillion global private credit market carries floating rate stress in its oldest vintage. And the AI earnings cycle contains a circular valuation loop that inflated nearly half of Alphabet's headline Q1 profit without generating a dollar of actual cash. And the most instructive historical parallel is not pets.com, it is Cisco. In March of 2000, Cisco was what NVIDIA is today, the genuine infrastructure company with real orders, real revenue growing at 50% annually, and a backlog booked 2 years out. Cisco briefly became the world's most valuable company near that peak, with estimates placing its market cap above $500 billion. The stock fell nearly 90% by late 2002, not because the internet was fake, but because the valuation had been pulled so far into the future that even genuine demand could not close the gap before monetary conditions tightened. Real underlying demand does not protect against valuation resets. That is the Cisco lesson. That is a legitimate concern. It is not a straw man. Here is why I think the bull thesis survives it for now. The productive infrastructure being built today is contracted, not speculative. A $460 billion Google Cloud backlog with 50% converting in 24 months is not a projection, it is a signed agreement. NVIDIA's $48.6 billion in quarterly free cash flow is not a valuation mark. It is cash generated by a business overwhelmingly driven by data center hardware demand. This is categorically different from the dot-com era, when the Buffett indicator peaked at 146% on companies burning cash with no revenue model. Today's AI cycle has a genuine demand foundation beneath the valuation. The question is not whether the foundation is real. The question is whether the financial superstructure built on top of it is proportionate to the foundation and whether the monetary conditions that sustain the superstructure can hold. The question is not whether bubble-like conditions exist. Pause. They do in the technical sense that valuation has raced ahead of the near-term cash economics. The question is where you are inside it, and whether the monetary financial conditions that sustain it can remain accommodative long enough for revenue to catch the valuation. The Ouroboros feeds itself. A snake can sustain this for longer than the bears expect because the real demand underneath it keeps the forward growth story credible. But it is, at some point, running out of tail. How fast it runs out depends on one thing above all others, what Kevin Warsh signals at his first press conference on June 16th. So here is what I would do with this. If you are positioned long AI, know which part of your thesis is the genuine demand signal and which part is the reflection. NVIDIA's company-level free cash flow is a signal. Google Cloud's contracted backlog is a signal. Alphabet's 46% net income contribution from unrealized equity gains is a reflection. Size your position for a world where monetary conditions stay accommodative and have a plan written down for when they don't. If you are waiting for the correction, understand that the correction does not come from fundamentals alone. Fundamentals are how you identify the fragility. The correction comes from the monetary hinge. Watch Warsh. Watch June 16th. Anyway, that's this week. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's quietvelocity, the number one, .substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm J.L. Maurer. This has been Conviction Bet.